Making money in the market requires looking past the math and focusing on psychology. Over the last 20 years, the Nobel Prize in Economics has twice gone to researchers who study human behavior rather than complex equations. Consider the typical salaried employee. Their professional life is built on the stability of a monthly paycheck, which makes them a fixed-income thinker by nature. To grow their wealth, they need the upside of equity. Yet that same psychological need for stability often makes them reject the very market risk they require. Entrepreneurs face the opposite dilemma. Their fortunes are tied to businesses that swing in value every day, yet they rarely seek the safety of fixed-income hedges. Instead, they often take on more debt to expand, doubling down on the risk they already carry. When the market hits an extreme, our biology takes over. The sudden rush of adrenaline or cortisol overwhelms financial logic, triggering a survival instinct that was never designed for stock trading. Building generational wealth requires rewiring these natural instincts. Success depends on how you handle the two psychological extremes of the market, the euphoric peak and the devastating crash. At the peak, greed takes over. When a portfolio jumps 50% in 3 years, investors begin to mistake a broad market frenzy for their own personal skill. They assume the upward trend is permanent. Avoiding this trap requires a tether to reality known as the base rate. In India, the major indices have followed a remarkably consistent economic rhythm over the last 30 years. This chart tracks that baseline. It combines a nominal GDP growth of roughly 6%, with 6% inflation and about 2% in annual dividends. Historically, this creates a long-term average return of 15%. Returns that significantly exceed this 15% average are usually market anomalies. Eventually, the market corrects itself, dragging performance back down to meet that historical mean. The contrarian move during these spikes is to trim excess profits. By moving a portion of those gains into fixed income assets, you protect the capital that the market frenzy has temporarily inflated. Securing surplus gains during a peak provides the dry powder needed to capitalize on the next inevitable downturn. Then comes the crash. In March 2020, the market dropped 40% in a single month as fear gripped the street. When everyone is selling, the consensus becomes that the morning will never come. This V-shaped dip illustrates a mathematical trap. When an asset drops from 100 to 50, it needs a 100% gain to break even. This visualization creates despair. The herd refuses to buy, seeing the path back as a near impossible climb. Professionals use the compressed spring framework. Stock prices are tethered to corporate earnings. While price plummets, earnings provide a floor. Pushed closer to this floor, the spring stores massive potential energy. When panic releases, it explosively recoils, rewarding those who bought at maximum compression. In Warren Buffett's rule about being greedy when others are fearful, others is the operative word. The goal is to act specifically when the herd has lost its perspective. A market crash functions as the storage of potential energy. It creates a window where wealth is transferred to those with the psychological fortitude to separate from the crowd. This psychology even dictates the personal portfolios of market experts. Ashish Somaya, who manages a $7 billion equity fund, chooses to keep half of his personal wealth entirely out of the stock market. He allocates that 50% to commercial real estate. It is a strategy that goes against the standard industry push for liquid equity investments. Real estate offers a unique advantage for young investors: bank-backed leverage. While lenders typically refuse to finance stock market speculation, they will provide significant capital for property because the asset itself serves as collateral for the loan. In a commercial setup, the rental income covers the bank's EMI. This creates a forced discipline vehicle where the investor builds equity over time without the ability to panic sell during a market dip. This also acts as a hedge. When government bond yields fall, commercial real estate valuations tend to rise because investors seek out the property's higher rental yield. True wealth is built by mastering these psychological tethers. It comes from understanding your base rates, utilizing collateralized leverage, and finding the discipline to buy the spring while the rest of the world is running for the exits.